Peter Rose, Longwood Currency Trading. Trading in terms of uncertainty. What do you do? How do you know when the times are different and that you need to do something different in a different time? And what are going to be the results if you don't understand this? That's what we want to cover here in this video. It's early June of 2022, and we are in turbulent times in the currency markets right now because of various, not only political issues in various countries, supply chain management issues, the war in Ukraine, pandemic issues, and now the travel industry is totally disrupted through not only illnesses but supply chain issues, and flights are being canceled, and people who had been looking forward to vacationing, there's thousands of flights a day sometimes being canceled. These are very uncertain times. And yet, if we were to be in certain times, if there ever is such a thing, and someone would say, look at all this cluster that's potentially could happen. In other words, somebody would describe this particular scenario to you. You'd go, oh my God, the world is going to come to an end. It's just nothing is going to go on, and I have to prepare for this. And in fact, when you're involved in those particular kinds of chaotic situations, it's not only not as bad as your projections of it could be, but you're also able to see more clearly as to what you need to do in order to avoid the problems. In trading, it's similar in that price action and order flow are somewhat relegated by the economic and political situations that the countries are involved in at any particular time. The problem is the time lag that happens between when the events themselves are occurring, or the news of the events that's out there, and the actual manifestation of that in price action. If you've been trading for any amount of time at all, you will note in this past week there have been tremendous travel disruptions, increases in the pandemic, and all kinds of considerations with the war. All those things have been brewing all around. But the travel cancellation of flights has really been dramatic. There's been a lot in the news about the supply chain issues, and that's been going on for weeks now. But when the supply chain starts to actually affect a traveler, then the shit hits the fan, right? Then normal folks become aware of really what's going on. But the currency markets are doing the opposite of what you would think should happen. In other words, if you look back at price action, it's very difficult to do this in a historical standpoint. You kind of have to be in the middle of the shit and in a trade in order to have this sort of thing reflect on you. But if you're looking at your chart and considering making a trade, and you're basing that trade on what you think is going to happen, remember I've said many times, save your opinions for movie reviews. Okay, well, this is an instance of that where it's just, for certain currency pairs, obviously you're saying, well, they should go up. One pair is going to go up, one pair is going to go down, and the net result of that is the pair is going to go up. The issue here is what should happen and what does happen are many times hundreds of pips apart. Why is that? Are the uncertain times confusing everybody? Well, who's everybody that's going to be confused? It's us. It's the retail traders, yeah? So why, if you feel that the price should collapse in the country that you're looking at, that currency pair should go down, because how much worse could it get? You know, and the economy is going to crumble under this. And yet the price is going up. And you get caught. it gets stopped out. This is where you get stopped out 3 or 4 or 5 times in a row when it's not the statistical likelihood that you'll get stopped out 6 times in a row. It's your own stubbornness in fighting what price is actually doing. Price is telling you something. It's going in the wrong direction for what your interpretation of the events are. And you get mad. Oh, it's going to, well, it's not going to do anything. It doesn't owe you anything. What's happening in the background is that there are large order flows that have been placed to sell. Let's just take the example of a currency pair that you think is supposed to go down. Should be heavy selling. But the price goes up. And in fact, the price is going up with, 4 times the ATR bars. You don't know what the hell's going on. That's where you get stuck. I got it wrong. It's going to go down now. I just got this one big bar, and it should retrace 50% because I believe in the Fibonacci dance of death. But it doesn't. It goes up again. It goes up again. And then it comes down to 50%. Well, why is it going up in the first place? It's because these large trading entities say, I've got to get rid of my product. I've got to get this out of here while the supply chain is working now because it should get worse, because I can get a better price right now. And so the folks, whoever those are, that are putting these huge multi-billion, trillion-dollar orders. Remember, the currency market's over $6.6 billion a day. The capital flows exceed that of all the stock exchanges in the world on a daily basis. And all of these customers of the banks are rushing for the exit doors. And the banks can't just sell everything to cause the currency to collapse because they wouldn't be able to satisfy their customer orders. And so they have to buy. And when they buy to shoot the price up to create large candles. Now, sometimes you see the terminus of that in a pin bar. The thing will go way up, for example, and then come way back down, and you get this long tail. But what happens when the orders are so massively stacked up on the trader's desk that price has got to go up a 4 ATR candle and another one and another one, and then it comes down 2 ATR candles, and then it goes up hundreds and hundreds of pips. It goes up. What's causing the price to go up? Is it confidence in the market? No, it's the large institutional traders that are putting buy orders in order to bring the price up to hit everybody's stops. Whose stops are they hitting? They're hitting our stops. Although we're a small component of the market, we're 15% of that. 15% of even 6 trillion is out. That's a lot of juice. And there are other banks who have satisfied whatever they need to do, and they're ready to close out their positions. So they're going to be buying into that. But they're not losing. Some of them will get clipped because they're behind in their order flow, or they're just getting the orders now, and the other banks have already fulfilled theirs, and so they're kind of caught in the flush. Not all the trades that these large institutions make work out. So the institutions artificially buy in order to gather inventory, and then when they've got it all and there's plenty of distance to sell to be consistent with where their client expects their orders to be filled at, they just dump it. And then you see the price go down several $100. Now, what many times happens is that it stops at this level, you would call that a resistance level, right? And that level gets, varies in its thickness, right? It's not just a line. 1.2246, that's the line, that's the level. Now it could be 10, 20, or 30 pips on either side of that, depending on the activity. And so when you see these prices come down and boom, and they get absorbed, those are really large bands of orders that are having to be satisfied. But at a certain point, nobody wants to buy. You're done buying. You either got junked out, or the institutions have all satisfied the orders, and now all of a sudden, several hundred pips later, and 10 days, 2 months later, the institutions, those that have been on the cusp with large client bases, and they're all trying to satisfy for the same reason, go, we're done, and then they sell. And everything goes down, and there's a lot of folks at the bottom that are saying, oh, it's going to stop at this resistance line, and it doesn't, and it goes right on through. And then they've bought, and now they're 20 pips out of the money, 50 pips out of the money, and now they're trying to scramble to get out of that, and they're selling. And the price then goes into another level block of trading range. Those things are the culmination of all that uncertainty. The uncertainty still remains in the market, but as far as the order flow goes, we've resolved what we needed to do, and now the currency is allowed to establish value at where it is for the cluster that's going on in the world at that particular time. But at that point, maybe the economics change. And so all the people that are now short, believing that it'll turn around and go short, and the market starts to go back up, it doesn't stop going back up. That's why you see these large pivot points, these swings or total reversal of trends that happen after 400 or 500 pips of movement, or several months, and then you get the point where the 55 or so period is coming up over the 200, or the 100 is coming up over the 200, and the direction, not only the direction of the 15-minute chart, because that's probably been going up for 8 or 10 days, but the market as a whole. And so when you're looking at these unexplained to you price movements in the market, step back from things. Let's look at the longer period moving averages and see what's going on that's been happening for a long period of time. What's the periodicity on average from trough to trough or high to high or whatever it is over, let's say you get on a monthly chart, so you're looking back over 5 years of trading. What's the periodicity of those cycles? What cycle, economic cycle, are we in right now? What cycle is the world in? Why isn't the price acting the way that it should act if it's in that particular cycle? So, though you don't trade on the news and you don't trade on the economics, underlying all of that, you have to understand that price action in the currency markets is based on order flow. It's unique in that way. Stock market isn't that way. Commodity prices aren't that way. It's unique to the currency markets. And it makes a currency trader a really good stock or futures trader because of the way that we deal with uncertainty and that we can manage our risk appropriate to the timing. Look, guys, I've said to you many, many, many times, any dumbass can teach you what to do, and some of them can teach you how to do it. But there are few out there that can teach you when you need to do something. And it isn't that there's a magic rule for when. I have a course that's 400 pages that's all geared around ultimately resolving or trying to resolve the issues of when can you expect that if you do something that it's going to perform in the manner in which you want it to perform in within the time frame chart that you're wanting to trade on, right? So you've got a lot of moving parts to this stuff, and it's all based on order flow. And the order flow is not based on what you think it should, even in highly erratic and chaotic environments and uncertainty, but just as a general order flow process. And again, order flow just isn't the order flow. It's why are orders being placed and the magnitude of those orders, how are those reflected in the price action, so you kind of get a sense for, whoa, wait a minute, this is going differently than I would have expected it to go. So it isn't that things are going wrong or against what you thought. What you thought may in fact be correct, but the timing is wrong. So your job as a trader is to figure out what that trading is going to be. And you can't do that by trading. You have to do that by having knowledge of the appropriateness of entry analysis, because that's really what you're concerned about is entry analysis. You don't care about position management or exit methodology. It's all hinging on are you going to take a trade or you're not going to take a trade. The rest of the stuff goes fairly smoothly. But if you're going to get clipped, it's going to be sometime around when you take your entry, right? And so not only are you combining the uncertainty of the price action at the time, but your own uncertainty. So it would appear to be a very complex thing. And in fact, as I've said many times, the market is complex, but trading it is simple. As long as you understand the importance of order flow and why that creates a when component to the what, how, and then the when, yeah. And then you can break your problems of trading down into areas of concern, like the trade entry area of concern. You can say, well, I'm looking at taking an entry in a trending market, or I'm looking at taking an entry in a chop market, a ranging market. You're going to approach those things the same way, but again, the when component is going to be different. The rules are going to be basically the same, but the when component of those rules may cause rules to invert and change around. It's difficult to learn that, and you won't probably be able to learn it if you're trying to do it on your own unless you have a pretty large bank account so that you can withstand a lot of losses in order before you go, oh, this is what's happening. That's what I had to do, because I relied on all the information that's out there and lost $40,000. Some of it was my own stupidity and hanging on too long, but it was all of the videos that you're watching and stuff that you're doing, guys, that's only telling you what to do and how to do it. That's not the solution. That's not the solution to the problem. I'm sorry. And that's why for folks that are going to be sharing their stuff with you, they're going to charge you a lot of money because it costs them a lot of money in order to learn that. So you can either pay the money 10 times over by trying it on your own and learning it on your own, or you can find somebody that you are compatible with as an educator and pay them whatever they're requiring to pay, so that you can learn how to do it quickly, as opposed to taking years and literally tens of thousands of dollars to learn how to do, and thinking and believing that the reason that you're not doing well is because of the uncertainty in the market and your inability to decipher what that uncertainty is. You would be wrong in thinking that way. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.